If you have money sitting in a UK bank account right now, there is something happening in 2026 that you need to understand before it costs you money you cannot afford to lose. The government can now see further into your finances than ever before. The rules about what happens if your bank collapses have changed in a way that catches out anyone still following the old advice. And HMRC is quietly collecting information about your savings interest without you ever being told. This is not about anyone doing anything wrong. The people most exposed here are the ones who did everything right, saved carefully, kept their money safe in the bank, and followed rules that simply do not apply anymore. So let's go through exactly what has changed, what it means for your money, and what you should do about it this week. Here is something most pensioners have not been told in plain language. New data sharing rules mean the Department for Work and Pensions can now request banking information, balances, payment patterns, transaction history from banks and building societies, specifically to check whether pension credit or other means-tested benefits are being paid correctly. An automated system reviews this data looking for mismatches. That means if your savings have moved above the thresholds that affect pension credit and you haven't told the DWP, it is far more likely to be picked up automatically than it would have been a few years ago. This isn't a scare story. It's simply how the system now works, and knowing it is the first step to making sure you're never caught out by it. So let me ask you a few honest questions. When did you last actually check the combined balance across every bank and building society account you hold? Do you know off the top of your head whether any two of your accounts share the same banking license? Because if they do, they are not protected separately, no matter how many different looking cards are in your wallet. And here's one for the comments. Are you someone who spreads savings across several banks because that's what you were always told to do? Or have you never really thought about it? Tell me which one in the comments below, because I suspect the answer will surprise a lot of people watching. Because here is the part coming up that really matters, and I want you to stay with me for it. There is one specific number, one single figure, that has changed the entire calculation for how you should be holding your savings in 2026. Get this wrong, and you could either be leaving thousands of pounds a year sitting on the table, or worse, believing money is protected when it isn't. I'll walk you through exactly what that number is and exactly how to check your own accounts against it in a moment. Let me tell you about someone many of you will recognize a little of yourselves in. Let's call her Margaret, 71, a retired school secretary living in Sheffield. She isn't a real person, but her situation is one that plays out for thousands of pensioners every year. Margaret had spent years splitting her savings across 4 different banks, sticking rigidly to the old 85,000 limit she'd read about a decade earlier, because that was the safe thing to do. What she didn't realize was that 2 of those different banks actually shared the same banking license, meaning a chunk of her money was never separately protected in the first place. She also had no idea the protection limit itself had risen. It was only when she sat down to do a proper year-end check of her finances that she realized her strategy hadn't kept pace with the rules. "I thought I'd done everything by the book," is the kind of thing people in her position often say. "I just didn't know the book had changed." Once she understood the new limit and which of her accounts genuinely counted as separate institutions, she was able to reorganize her savings in an afternoon. With nothing more complicated than a phone call to each bank and a look at the FSCS website. Now let's get into the detail properly, because this is the part you actually came for. First, what's changed? From the 1st of December 2025, the Financial Services Compensation Scheme protection limit rose from $85,000 to $120,000 per person per authorized banking institution. For a joint account, that's $240,000 protected. There's also a separate temporary protection of up to $1.4 million for genuine one-off large sums, the proceeds of selling a house, an inheritance, a compensation payment, protected for 6 months from the date it lands in your account. That's a real welcome increase, and it means many people who spread their savings thinly across several banks specifically to stay under the old limit no longer need to. But, and this is the bit that catches people out, that protection applies per banking license, not per famous high street name. Several household name banks operate under one shared license. Halifax and Bank of Scotland are one. NatWest and Ulster Bank are one. Nationwide and Virgin Money are now one, following Nationwide's takeover. So if you've got 120,000 in Halifax and another 120,000 in Bank of Scotland thinking you're doubly covered, you're not. You're only protected up to 120,000 combined, with the rest sitting exposed. Before you move a single pound this year, it is worth 5 minutes on fscs.org.uk checking exactly which license each of your banks sits under. Second, who this affects. It affects anyone holding savings anywhere close to 6 figures, and it affects anyone receiving pension credit whose savings or income has changed without them updating the DWP. If you get pension credit, savings above $10,000 start reducing what you're paid, and savings above $16,000 disqualify you from it altogether. With banking data now more visible to the DWP than in the past, an unreported change is more likely to surface as an overpayment, and then overpayments can be recovered directly, sometimes without you being asked for consent first. If you think you might be in that position, the right move is always to contact the DWP yourself through gov.uk or the number on your most recent DWP letter, rather than wait for it to be found for you. Being upfront is treated far better than being caught out. Third, what you should actually do. Large transactions deserve a moment of care too. Banks are required to file suspicious activity reports if a transaction looks unusual against your normal pattern, and that threshold can be as low as a few £1,000s. This isn't about honest pensioners doing anything wrong. It's about how automated compliance systems work. If you've sold a house, received an inheritance, or had a large one-off payment, the simplest approach is to deposit it as a single transaction, keep the paperwork, solicitor's letter, probate document, sale contract, and if a bank asks, give them a simple, honest answer, I sold my house, or it's an inheritance. What you should never do is try to get around monitoring by splitting large sums into smaller amounts across different accounts. That's called structuring. It's a criminal offense under the Proceeds of Crime Act, and it applies even when the money is completely legitimate. So the safest and simplest path is always to be straightforward about where money has come from. Now, on to where your money should actually sit, because this is where a lot of pensioners are quietly losing money every single year without realizing it. Leaving a large sum in an ordinary current or standard savings account, earning 1 or 2% is one of the most common and most avoidable mistakes out there. 100,000 sitting at 1.5% earns you $1,500 a year. The same 100,000 in a competitive cash ISA at around 4.5% earns roughly $4,500 a year. Completely tax-free, a difference of $3,000 every year or $15,000 over 5 years just for moving your money to a better home. And that tax point matters more than people think. HMRC now receives your savings interest information directly from your bank, and interest above your personal savings allowance, $1,000 a year for basic rate taxpayers, $500 for higher rate taxpayers, is taxable. Using your $20,000 a year ISA allowance per person shelters that growth from tax entirely, indefinitely. And for genuinely risk-free options, National Savings and Investments is backed directly by the UK government, so it sits entirely outside the FSCS limit altogether. Every penny you put in is guaranteed. Premium bonds, up to $50,000 per person, $100,000 for a couple, offer tax-free prize returns that have averaged around 4% recently, with the added appeal that winnings never affect your personal savings allowance. So here's the simple framework worth holding in your head for the rest of 2026. Keep around 1 to 2 months of everyday spending in your normal current account. Keep 3 to 6 months of expenses in an easy access savings account or cash ISA you can get to instantly. For anything you won't need for 1 to 3 years, a fixed rate cash ISA or fixed savings bond at 4 to 5% makes your money work properly. And for larger, longer-term sums, NS&I and premium bonds up to $50,000 per person give you complete government-backed security with tax-free upside. Coming back to Margaret's situation once she understood where the real limit sat and which of her accounts genuinely counted as separate protection, reorganizing her savings took her one afternoon and a couple of phone calls. She moved a chunk of her cash from a low-interest instant access account into a fixed-rate ISA, checked her pension credit figures were accurately reported, and for the first time in years actually knew exactly how protected and how well her money was working she really was. There is real dignity in having worked and saved your whole life, and there is real power in simply understanding the rules well enough that nobody else gets to catch you out on them. The one thing worth doing today, not next week, is sitting down with your bank statements, checking your total balance at each institution against the FSCS website, and comparing your current interest rate against what's on offer through NS&I or a top cash ISA. 1 hour, and you'll know exactly where you stand. Thank you for watching. If this helped make sense of a confusing year for savers, please share it with a friend, a parent, or a neighbor who could use the same clarity. Let me know in the comments how your own accounts stack up against the new limit, and I'll see you in the next one.